right now the market's really focused on companies that are going to grow. And that means your tax rate's going to improve, but are you going to have organic top line growth? Because one of the fears of the market is as we get rates starting to increase, more and more investors are going to move money out of what we would call the dividend stocks or the bond substitution stocks and move towards fixed income. That leaves companies that are going to grow organically, again, top line growth. That's where the market's really looking. And within that, you're going to see sector rotation. So money coming out of telecom, utilities, moving into what we think are cheap, growthy areas like financials, select tech, and industrials.
You know, the tech and financials have been kind of the plays that people have been talking about for several months, actually more than half a year in some cases. What makes you think that there are still values there?
If you look at them on a valuation basis, especially financials on a price to book and a PE basis, they are lower than the market with higher growth rates, better balance sheets. And if interest rates start moving up, you're going to get that tailwind in terms of net interest income. Plus, if you look at domestic banks, they've got a tax rate positive advantage as well. So I think those things haven't really been baked in on the financials. Tech, we know, kind of has secular growth. And then one other thing that I think when you get this rhetoric out of DC, you will see potential to buy, areas in healthcare, especially biotech, if there's some pricing pressure on drug prices.
Meaning that when the rhetoric comes from DC and they're talking down drug prices and the drug companies suffer as a result, you think that's a buying opportunity?
Absolutely, especially companies like a Bristol or a Celgene that have drugs that could be potentially life-saving and not just Me Too drugs. And I think there's a value there for those companies, especially when you look at their multiples and you look at their growth rates compared to kind of what they trade at today.
John, let's talk about GDP. The fourth quarter number was disappointing, but we hear from companies across the board that things are going incredibly well. What's the real picture of the economy?
Well, I don't think you can focus on any one quarter's number for the economy, but here's the problem for the U.S. We are pretty much at full employment at a 4.1% unemployment rate. And the productivity growth rate of the economy for the last 10 years has been very disappointing. Despite all the technology that we see around us, it's been very disappointing. Demographics are difficult for further growth in the labor force. So the economy's potential to grow is relatively low at the present time. Hopefully, capital spending from the tax cuts will change that over time. But that sort of thing isn't changing tonight. The demand side looks quite strong. So here's the issue. The economy's demand, consumer spending, investment spending is growing north of 3%. The economy's potential to grow is 1.5% to 2%. So looking at the output side, looking at the GDP side of the economy is very different right now than looking at the demand side of the economy.
So what does that mean, though? Is it a strong economy?
What it means is two things. One is that the trade deficit is going to grow considerably over the next couple of years from where we are now. And secondly, we're at a point where we're seeing nascent inflation pressures. And that's really difficult for the equity market because what justifies the broad market is the high level of multiples, which comes about because of the low level of bond yields. And if we start to put inflation into the mix in 2018, that's the biggest wild card for valuations and equities that are out there.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.